The average automobile has over 30,000 parts. For over 90 years, GPC has consistently provided replacement auto parts to both individual consumers and businesses, alongside a variety of industrial parts used in many other facets of the economy. My name is Emma Smith.
I'm Christian Berner.
I'm Eric Bergman.
And I'm Ryan Henderson.
And we initiate coverage on Genuine Parts Company with a hold recommendation based on the following key points. First, our valuation. Second, its increasing competition. Third, its strong operations and supplier network. Fourth, its ratios. And fifth, the future risks that it has on the horizon. Our hold recommendation is based off of the following three valuation methods: a relative multiples valuation, a discounted cash flow valuation, and a dividend discount model. And our target price is $120.84, which is a 2.12% downside from the current price. GPC is engaged in the distribution of automotive and industrial replacement parts and is divided between the two segments. The automotive group operates primarily under its brand name Napa Auto Parts, and it counts for 65% of GPC's total revenue. It is a premier global auto parts network and has partnerships with Firestone, Goodyear, and AAA. The industrial group operates primarily under the brand name of Motion and serves as the leading MRO distributor in North America and Australasia, with access to over 10 million parts. Eric is going to dive deeper into GPC's competitive positioning.
Thank you, Emma. GPC faces heavy competition from companies both established and new. Operating within a highly fragmented industry, GPC accounts for 8% of the automobile market and 3% of the industrial market, despite being considered a key player in each. E-commerce companies Amazon and Walmart have disrupted the automotive aftermarket, especially within the DIY sector of the industry, occupying a combined 28% of individual consumers' auto parts as of summer 2021. And while the automotive aftermarket is projected to grow by about 4% annually, the e-commerce auto parts market is projected to grow by 11% annually to reach $22 billion by 2023. Though GPC has made strides with their website Napa Online, now offering in-store pickup and free one-day shipping, their longtime competitors have been teaming up with these massive retail companies. Advanced Auto Parts, for example, inked a deal with Walmart in 2018 to create a specialty store on Walmart.com, which has allowed Advanced to have a much wider audience base than before. And while it is true that DIY customers only account for 20% of GPC's automotive group's total sales, the DIFY segment, accounting for the other 80% of sales, could find it increasingly difficult in the coming years to repair cars. Automakers such as Subaru, Nissan, and Volvo say that repairs done on more sophisticated systems such as autonomous braking and blind spot detection will affect the warranties of the cars. It's a policy that independent repair shops believe locks them out of such advanced repairs. In fact, the Motor and Equipment Manufacturers Association has asked the Federal Trade Commission to get involved. As of now, automakers control warranties on advanced equipment despite being restricted on doing the same for more of the traditional parts that GPC is more accustomed to. And according to Reuters, automakers are making their cars much more difficult for the independent repair shop to fix. Nowhere is this more true than with electric vehicles. GPC even admits it in their latest 10K, saying they may not be able to accurately predict or prepare for these new technological innovations brought about by the advent of EVs. And while this may not be a problem now, considering the fact that electric vehicles make up only 5% of cars on the road, by 2030, a KPMG survey states that auto execs predict that vehicle sales will be 52% electric in 2030. I'll hand it off to Ryan here for the financial analysis.
Thank you, Eric. So I'll dive a little into our financial analysis that we used to derive some assumptions that we then took into our valuation. First off, GPC has been a strong candidate in the industry historically, relying on strong supplier relationships and economies of scale to help drive revenue growth. They've had three main business segments up until very recently when they completed a divestiture of their business products group, S&P Richards, which was completed in about mid-2020. Having those three main business segments gave them diversified revenue streams that gave a counterbalancing effect in which if there's an economic downturn in one segment, it would hopefully be picked up by the other two. The market as a whole is primed for an uptick as consumers start getting back on the road, start traveling more and more in a post-pandemic environment, putting more wear and tear on their vehicles, and therefore driving up the demand for the replacement parts GPC provides. GPC posted consistent revenues throughout the pandemic period. However, we feel this may be a tad inflated due to the fact that the average consumer went out and got maintenance done on their vehicle that they had been pushing off for a while once they received their stimulus package. The question is whether GPC can continue a strong historical performance in today's current market conditions, and despite decreasing their cash conversion cycle from 58.08 days in 2017 all the way down to 13.58 days in 2021, as you can see by the graph on the left or right, the GPC's net operating margin has been on a steady decline since 2012, reaching recent lows of 5.2% and 2.51% in 2019 and 2020 respectively. GPC also lags its competitors in a few key margins and measures. As you can see by this graph on the left, its EBITDA margin for the past 3 years has been lagging severely from 3 of its closest competitors, and then it also lags in cash flow from operations, return on assets, and return on invested capital. I'll now pass it over to Christian to handle our valuation.
Thank you, Ryan. The first valuation method we used was the discounted cash flow valuation. Using a top-down approach with quarterly projections, we forecasted free cash flow until 2025. We found a terminal value using a 3% terminal growth rate and an 8.56% cost of equity. We discounted our cash flows to present value using a 7.52% weighted average cost of capital. After we summed our cash flows to get the enterprise value, we took out debt and divided by number of shares to deliver a stock price of $126.52. The second model we used was a dividend discount model. We forecasted dividends in 2025 using a 5% dividend growth rate and then assumed a 4% perpetuity growth rate after. We used an 8.56% cost of equity to deliver a price of $106.69. Lastly, we used a relative multiples valuation. The 3 comparable companies we used were Advanced Auto Parts, O'Reilly Auto Parts, and AutoZone. We picked those 3 firms because they were similar to GPC in the nature of their business and they had comparable ratios. To value GPC, we used GPC's EBITDA and multiply it by the peer group's average of EV over EBITDA to deliver an implied EV value. After adjusting for equity and dividing by number of shares, we came up with a stock price of $121.68. To summarize our valuation, we used a 60% weight for our DCF because of the confidence we have in our financial model and the fact that GPC is a mature firm. We used a 15% weight for our DDM because of the difficulty in forecasting dividends and the headwinds that GPC faces. We also used a 25% weight for our relative multiple valuation, which gave us a final stock price of $120.84. Lastly, here is a football field visual of the 52-week range, target range, and our 3 multiples, or valuation methods. Next, I'll pass it to Ryan, and he'll tell us about risk.
All right, so obviously there's a lot of risks that can impact a company as large as GPC. However, I'll just highlight a few of the more pressing matters that we identified. First off, I'll start off with inflation. Inflationary pressures will cause GPC to make a decision whether to pass those costs on to the consumer, possibly decrease in demand in the coming years, or to absorb them internally and continue to post lower margins even than before. 2 that kind of go hand in hand with each other are the adoption of electric vehicles and oil prices. Obviously, as oil prices continue to rise and become more volatile, it may push the general consumer base to adopt electric vehicles a little earlier than expected, as GPC stated that they expect the market share of electric vehicles to be 10% in 2030. And now I will pass it over to Emma to finish off with ESG.
Thank you, Ryan. Environmental, social, and governance scores evaluated companies' sustainability risks on a scale from 1 to 100, with lower scores being less risky and more favorable. As you can see in the graph on the right, GPC performs right in line with its peers, earning a score of 13. Diving a little deeper into its governance structure, GPC's board of directors is made of 13 members with an average tenure of 7.5 years. Stock option compensation is also paired with executive compensation to align shareholder values with executive values.
1 minute remaining.
In conclusion, while GPC has a highly developed operations and supplier distributions network, it faces strong headwinds in the form of competition, as well as new technology on the horizon. We feel that GPC is currently fairly valued and should be viewed by an investor as such. Thank you very much for your time, and we will now open the floor for questions.
Chart showing the company's operating margins and the decline over the last 10 years, whatever time period that chart was. Yes, thank you very much. When you considered that decline in operating margin, how much of that might be impacted by changes in the business mix? And what other factors might be contributing to that declining operating margin? And we'll just ignore the sort of the 2020, the COVID thing, but clearly there was a decline that you pointed out, but why and how does that impact the future growth potential of the company?
So it's been declining for a while, obviously, but we kind of felt that with the divestiture of the business product group and not necessarily being able to diversify the loss between the three groups and hopefully the uptick in the two, that obviously the 2020 year is pretty bad, but the given decline before that will kind of continue to decline based on the fact that the volatile market will most likely not necessarily be as stable as it was before, and then they won't be able to regain the losses that they've had in the three segments before.
And I think another huge part of that is Amazon and Walmart entering the fray as well. They're both huge players in the United States economy, and they have a ton of money to be able to pump into whatever industry they want to be able to pump it into. And since they have pumped it into the automotive aftermarket, I think that's made the industry a ton more competitive, which has driven down the operating margins as well.
So it's because prices are going down? I mean, are prices going down, are prices not going up, are expenses going up?
Well, due to it being more competitive, I would say that they would have to lower their prices to be more competitive, especially within the DIY segment of their industry. So yeah, that has definitely caused them to lower some of their prices.
Thank you.
How did you consider the company's history of acquisitions in your analysis?
One of the things we looked at was the dividend discount model, and one of the things that we were impressed about was that GPC has been able to maintain a very high level of dividends compared to their peers, compared to with their net income. They've had around a 50% dividend discount ratio, or dividend payout ratio, that is, and they've been able to continue to acquire all these companies. So that was definitely a positive point for us in our valuation, considering the fact that they've still been able to have enough capital left over in order to make these acquisitions. They are able to prove to these financial companies. So I know they had a recent loan with both Truist Securities and JP Morgan in order to acquire Cayman Distribution Group. And they've proven in the past that they've been able to pay those loans off by their acquisitions. And we believe that the companies that they have acquired have contributed to their positive outlook overall, and will continue to do so for the future.
So it's a positive factor.
Definitely so.
Thanks.
Can you talk a little bit more about the potential impact of the growth of electric, the market share growth of electric vehicles on their business? I think you cited a statistic that it was going to expected to go from 5% of the car market to 50% of the car market by 2030, which is only 8 years from now.
Right. And that's, yeah.
We stated that the new car sales will grow to 52%, but the overall market share of electric vehicles will be about 10% by 2030.
Thank you.
And with that, there's going to be a whole host of new innovations that GPC are going to be forced to adapt to, and they acknowledge that in their 10K. As I stated, they're just going to have to wait to react to see how they can get involved within these electric vehicle companies. I know Tesla has only about 17 parts in their engine compared to over 200 parts in the typical internal combustion engine. So they're definitely going to have to rethink a lot of their parts and how they sell those to consumers.
So what's the company doing about that?
Well, I believe, I don't know. What do you guys think?
I would say the company is obviously trying to counteract that influence as they try to grow not only their current business but adapt to the future. So they do have a partnership with, I believe, I can't pronounce it, it's like Ryobi, in which they've partnered to be the sole supplier of their electric vehicle parts for the future. So they have made some sort of assumptions or growth in that aspect, but they are kind of trying to counterbalance their aspects that they have now along with the growth in electric vehicles.
Thank you.
Right. It's also not the biggest threat that we've seen so far. It's obviously a headwind that they're going to have to consider for the next 10 years, but we're still concerned of coming out of the pandemic, and as he said, it's going to be projected 52% of sales in 2030, but it's only going to be 10% of the market, so it's definitely something to consider, but as of now, it's not the biggest threat.
Has the company articulated a specific acquisition strategy, like where they're looking for acquisitions, specific markets, size, anything like that?
Well, so they currently have a ton of cash on hand, over $900 million on hand, as you can see up here. And on their investor call, they said they're trying to target to have around 500 in cash. So they said they're going to look more into, more mergers and acquisitions just to get down to that number. Currently, they have a very good presence in North America and in their industrial parts group in Australasia. So maybe they could try and get into Europe for the industrial parts because they have no presence currently there. But yeah, they have a ton of cash, so they're ready to get rid of it because they just went into cash conservation mode during the pandemic.
And I think it's also important to note that they look for companies where they know they can improve the distribution network within that companies, because that's one of the main things that GPC does so well is their distributions and solutions network. So if they see a company where they know they're able to quickly adapt and put that right into their own business model, then I think they view that as a very positive factor, and they will look much more into acquiring that company.
Thank you.
On valuation, could you unpack the DCF a little bit more for me, your
Absolutely.
assumptions that you made and the sources?
Do you want to go to the DCF page? Or do you want to go to
You can get to the DCF page. Okay. So as far as our free cash flow goes, we first broke down our revenue model into quarterly, and so we were able to determine a free cash flow from there.
Do you want me to pull that up?
No, you're good. We assumed a 3% terminal growth rate because we didn't want it to be higher than the average GDP. We thought that was a fair assumption just because the firm's mature. We calculated our cost of equity. If you want to go to that page as well, we can show your calculation for that. Yeah, get back. So as you can see, here's our cost of equity calculation over here, and we were able to derive weighted average cost count from there. And those
The
are the figures
weighted
we used.
average cost of the capital is your actual balance sheet, firm balance sheet, or? how-
We calculated that. Yeah.
Zooming out a little bit, can we talk a little bit more about the headline recommendation of a hold, given that the price target is below today's current price, and whether that hold recommendation is relative to broader equity markets or expected industry performance or what?
So we actually have a target range of $114.59 to $127.48. And we believe, obviously we're in a volatile time, so right now we believe it's just better to hold it, even though there's over a 2% downside to the current price in our target range. But we thought right now a hold was the best way to go about it because there's a lot of uncertainty in the world right now, and we believe like a 2% downside wasn't very wasn't like,
Volatile.
yeah, very.
These days that can happen any of these days with any company, 2%.
So what is the time frame of the recommendation? 3 year, 5 year?
1 year.
Yeah.
1 year.
1 year.
We got one minute remaining, so we'll take one more question.
Well, judges, if there are no more questions, then thank you very much, Team I. You did a great job, and best of luck.
Thank you.